Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
Are you a new or experienced investor wanting to learn how to have a successful syndication business? Learn from the nation's leading syndication expert, my friend, Whitney Sewell Chopra. He has created a multifamily academy where you will learn everything about deal analyzing to selecting emerging markets, managing assets, and much more. In the academy, you'll find over 500 lectures and templates to help you run a successful syndication business. Your membership also gives you access to Vinny every Wednesday through masterminding and coaching calls. Vinny came to the U.S. with only $7 and now is a CEO of 5 companies, acquiring and managing a portfolio of more than 3,500 units. He's completed 26 successful syndications ranging from 50 to 500 units and created a portfolio valued over $200 million in commercial real estate. He built the academy to teach and mentor investors like you to succeed. To learn more about the Multifamily Academy, text LEARN, L-E-A-R-N, to 474747 or call his team at 925-766-3518. This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, our guest is Jeremy Roll. Thanks for being on the show again, Jeremy.
Yeah, Whitney, thanks again for having me. Really appreciate it.
I'm always excited to have Jeremy on the show. He has such a deep understanding and a level of experience in this field, and has helped so many people invest in real estate and do it well, or in many different types of businesses, but specifically real estate. And you probably heard him yesterday on the show, and I hope you did. And if you didn't, you need to go back and listen, because this is going to be a continuation from yesterday's show. We're just really getting granular on some of these topics and helping you to understand the due diligence that needs to be done as a passive investor. But in case you didn't hear a little about Jeremy, he started investing in real estate and businesses in 2002 and left the corporate world in 2007 to become a full-time passive cash flow investor. He is currently an investor in more than 70 opportunities across more than $1 billion worth of real estate and business assets. As founder and president of Roll Investment Group, Jeremy manages a group of over 1,000 investors who seek passive, managed cash flowing investments in real estate and businesses. He is also the co-founder of For Investors by Investors, also known as LFIBI, a nonprofit organization that was launched in 2007 with the goal of facilitating networking and learning among real estate investors in a strict no-sell pitch environment. LFIBI is now the largest group of public real estate investors meetings in California with over 27,000 members. Jeremy, thank you again. I'm always honored to have you back on and to have you on the show. And I'm looking forward to us continuing this conversation. And, just a slight recap, we talked about regarding the due diligence of a passive investor needs to be thinking about as they're communicating with deal sponsors. And we went over, doing the background check. And I really like you just dove into even things that they need to be looking at, or maybe things that aren't necessarily important or red flags, but also red flags that could come about as you're doing a background check. And you also went through operating agreement and different terms and things that, most passive investors may not be familiar with initially, but some very important things that you need to know that are laid out there. So when the money's all dried up, we know where it's going to come from or what's expected at that time, if that happens. And it's a matter of, if it happens, we need to know what's going to happen, right? Or what's expected. So, but a few more topics we wanted to dive into, Jeremy. Obviously PPM, and we were going to get into the on-site visit and possibly meeting this person or the operator in person. But, take off with let's dive into the PPM and what that is and why that's important.
Sure, yeah. So just for everyone out there, I'm not an attorney, so I'm giving you my best investor hat, opinion about the PPM. So PPM is actually a private placement memorandum, for those of you who are not familiar. And it's essentially a document, almost like a disclosure document that the SEC, I wouldn't say mandates necessarily, but most operators will use it because it's a more conservative approach. And actually, I would say that if you find a deal that is pulling many investors together that does not have a PPM document associated with it, it's a yellow flag. And what I mean by yellow flag is it could be okay. I've actually seen the odd operator, just to keep things shorter, actually disclose all the risks in the operating agreement document. But that's a very unusual decision and very uncommon. I would say easily 9 times out of 10 or more, you should see a PPM. And if you don't, make sure you ask if there is one. If there isn't one, that could tell you something about the operator, could tell you they're trying to cut costs or cut corners that they shouldn't be. And they're not being conservative for themselves even. So now the PPM is important because I'd say the most important function that it serves is to actually disclose risks to investors. It's got some other disclosures as well, but the risks are really, really critical. So, I would say that if you're brand new and you start reading it and it has 20 pages of risks disclosed, I would tell you not to get too overly concerned about it, and that the job of the PPM is to be as thorough as possible and maybe disclosing a lot of what I call 1% or below 1% risks that you should still be aware of. Stuff that you may find in there would include conflicts of interest with the operating partner and possibly with either some of their partners or other companies. It could be environmental risks. So as an example, something you might see is just a general cookie cutter disclosure that the operator has done kind of a stage 1 or stage 2 survey, environmental survey, or phase 1, phase 2, but hasn't may not be aware of some environmental problems that may come up after the fact, and that they've hired professionals to do this type of work, but that it still may have not come up in the fact because there were samples of soil and maybe not caught it in the specific samples. So just those types of risks that you should be aware of that could cause huge problems down the line as an investor. There's loan risk concern, being able to refinance loans down in the future. We won't know what the property be worth if a loan has to be refinanced. So all these things that can happen, you should be aware of. It is critical that you read those risks, because just like the operating agreement, where you're trying to understand the rules of what you're getting into, you clearly want to understand the risks of what you're getting into. I'm assuming every investor would agree with that. It's unfortunately rather lengthy legal documents, and it's not the most fun document to read. But if you do read it, and you should, then you will get a better idea of at least understanding what the risks are before deciding you want to invest. It's really critical.
Could you give us any key things that we should look at? I mean, most people aren't going to take the time to read the PPM when it's over 100 pages of small fine print.
Yeah.
Anything specific that, or maybe there's a couple of things that when you see a PPM that you're going to go directly to before you spend time to go through the whole thing?
Well, I will say this. Let's put the risks aside for a second, because those are the obvious things to look for.
Right.
Usually in the PPM, it discloses any fees for the operator and the structure of how an investor may get paid back in terms of a preferred return and some profit split, for example, and a lot of other important disclosures. I would say certainly be sure that you're paying a lot of attention to all the fee disclosures, so you understand what the fees are. There could be or will be acquisition fees, management fees. Sometimes there's construction fees. And to be honest, there could be any fee, right? Because an operator can decide to put any fee in there they want. You may determine by reading the PPM that there are some fees you don't agree with, and then maybe move on to the next opportunity because you read the PPM and saw them. Whereas if you just look at the business plan and the overview that's sent to you, it may not be as obvious. It may not even be disclosed in there necessarily. The disclosure document, the official one, is technically the PPM. And so you definitely want to be very careful reading through that.
So I know in the last show we talked about we talked about the operating agreement, and now we're talking about the PPM. Could you just, tell us the relation of those, or maybe when you would get one over the other?
Yeah, so sometimes you get one document that is the PPM and the operating agreement together, just so that you can read it all in one place. It's more convenient. Sometimes you get them separated out. But it is important to understand that the operating agreement, the best way I can kind of describe it as a non-attorney, is it dictates all the rules for the company you're investing in. The rules that have to be abided by the operating partner as well as the investors, right? Because there are rules about how that dictate, what investors can and can't do, as well as what the operator can and can't do. So the rules are critical. The PPM is a disclosure of the risks and the structure of the opportunity and a lot of other important things, but they're not necessarily the rules. There may be some reiteration of some of the important rules that are pointed out and highlighted in the PPM to make sure that it was clear to investors from a legal protection standpoint for the attorneys to protect the operator, to make sure that the investor saw it. But they are somewhat separate, even though sometimes they're actually put together in the same document, so to speak. So one follows the other. Usually you'll see the PPM first, and then the operating agreement be an exhibit or an addendum to the PPM. That's usually how it's laid out.
When are you going to hire somebody to help you review that? Or maybe when you said, you've reviewed many, but a lot of investors have not. When would you maybe suggest that they, hire their own attorney or somebody else, legal counsel, to review this with them or for them?
Great question. So keep in mind, everybody, I'm not a financial advisor, any advisor. So this is just my perspective as an investor. But if you're brand new, you don't really understand what you're looking at, it can be very valuable to hire an attorney. But if you're going to do that, please, and I made this mistake when I started way back when, make sure you hire someone who is an attorney that actually puts these together. They're typically called securities attorneys, and make sure you're dealing with a securities attorney who actually deals in real estate opportunities specifically, and these syndications, they call them. The reason why it'd be good is because then you're hiring an attorney who's an expert in putting this specific type of document together that also understands what's typically there in terms of the risk disclosures, what's typically there as far as the rules, and they can give you some guidance on what they maybe put in normally versus what's missing, or vice versa. And so that is going to be by far the most valuable feedback you're going to get. What I'm concerned about for the listeners who are listening, and what happened with me when I first started, if you get just a general attorney who does real estate transactions, or an attorney who doesn't do real estate, it's just any other type of attorney, they may start to look at all these risks or all these rules and say, this is too prohibitive. Oh, there are too many rules. You're too constrained because you're passive. You have no control. I mean, that is the nature of passive investing. And so that feedback isn't really relevant because they're not comparing what documents should have in them versus not. They're just saying you don't do this because you're not going to have any control, or don't do this because there are too many risks. Well, that's not necessarily the best feedback, right? But it does happen from attorneys, and it happened to me. And so a lot of the attorneys who are not familiar with these structures will just try to dissuade you from going into them because you're giving up control and for other reasons. And those are some considerations that are very important, but it doesn't mean you shouldn't invest in these types of opportunities. You just need to understand an apples to apples comparison of what these legal documents have in them versus what are customary and important things that may be missing, right? And that's the kind of analysis you want. You're going to get that from that right type of attorney.
Okay. And some of that would go back to knowing who this operator is, like we talked about before as well.
Yes. That is true. But at the same time, if you want it, it's important you hire the right type of attorney if you're new. If you hire the wrong type, all you're going to get is 20 reasons not to invest in something. What you really want is an apples to apples comparison of what the documents should have in them and we're missing, and also what you should understand about how these things work and what you may want to consider for yourself in terms of the constraints. All that knowledge is going to come from the right type of attorney, and if the wrong type of attorney won't give you any of that. So
you don't go to a brain surgeon for heart surgery, right? Perfect
explanation.
No, awesome. So yeah, PPM can seem so daunting. You get this 100-page document, but it's great advice. You know, especially if you've never reviewed one before, hire the right attorney to help you walk through that. It's going to be money well spent. You're going to be better educated because of it. And so, anything else on the PPM that you just want to make sure to elaborate on before we move on?
Yes, please read it. And I know that sounds obvious, but I'm convinced that a lot of investors do not read the PPM and do not read the operating agreement because they're kind of longer, more mundane legal documents. They're some of the most important things you can review in the opportunity to understand what you're getting into and whether or not it even makes sense for you. Putting the entire opportunity aside, you may completely disagree with some of the rules in the operating agreement, for example, but if you don't read them, you'll never know. And in the last episode, and I won't repeat again, but if you didn't listen to the last episode, I recommend it. I did share an example of something I once saw in an operating agreement that was shocking, and that I'm assuming that nobody read the legal documents before they invested, or they would have never agreed to invest. And that's how important it is to review them. So please do review both those documents. They're very, very important.
Great. Yeah, if you don't read it, there's no way to know. So, but we're going to move on to this on-site visit that we referenced earlier, and what you really look for, maybe when you would do this, or are there times that you wouldn't do it?
Great question. So, yeah, now I'm a full-time investor, so I have the time and ability with my more flexible schedule anyway, to actually decide I want to go out to your property. I realize not everybody listening to this has that. I was in the corporate world for over 10 years. I realize it's very hard to just get up in the middle of the week and leave your job. But if you're possible, if you've never invested with an operator before, I strongly recommend an in-person visit. The best in-person visit you can do, in my opinion, is, well, there's twofold. One is to go to the head office and meet a bunch of their staff to make sure they're actually all legitimate and there, right? And the office actually exists. The other would be an on-site visit. And what you get from an on-site visit is both a much better understanding of what you're about to invest in, as well as the ability to potentially read through the lines, like we talked about in the last episode, about who you're investing in, because you get an idea of just how thorough they are and how thorough they've been in analyzing the specific both opportunity, actual property, as well as the surrounding area. Those are very, very important points. Now, you asked a good question. When would I not go for a site visit? Generally, I strongly prefer to go for site visits. Sometimes it's not realistic because of scheduling conflicts and all this, but I would say this: if I've invested with somebody multiple times, I know how thorough they are, and it's an easier property to be able to analyze from afar. So let me give you an example. I would say an average apartment building, which a lot of you out there I'm sure understand because you've either lived in them or invested in them, in a very strong demand area, in a larger metropolitan area, you could probably walk some streets and kind of get a good idea for where it is and what it looks like, okay? A self-storage property that typically might get 50% or more of its revenues or new occupants from drive-by traffic, which is actually a true statistic in that industry. Much more important to really understand exactly where it is. It looks like it's on a highway, but are you going to drive the highway and see if you can see it, or are there trees blocking the view? Is the signage actually visible from the highway, or are they just using the smallest sign or the wrong sign in the wrong area and then you can't see it? These are not necessarily things you're going to be able to figure out unless you're actually there. So there are certain asset classes that are easier, I think, to invest in from afar than others, but I wouldn't recommend doing any of that unless you've been on a tour at least once, if not multiple times, with a specific operator and you've gotten to know them really well.
So, I know there's times, obviously, where a lot of operators, including myself, are purchasing properties that are a long ways away, or, where I'm not right there all the time. And so, what about, trying to arrange that may be difficult, obviously, at times, with both of our schedules, but the operator just, for instance, says, well, I can't be there at that time, Jeremy, but you're welcome to go, or I'll have somebody else, or make sure the management company knows, that you're going to be there walking around. Is that going to be okay with you, or are you going to say, no, I'm going to wait till you can be there? What does that situation look like?
Great question. I think on a first time out, I think I'd have a lot of difficulty going out there without the operator. I think that the way you can get around that, or at least make it somewhat valuable, is to maybe go to the operator's headquarters, validate them there, meet them in person at least, and be able to do that gut check on them because you met them in person, and then fly out separately to do an on-site visit, preferably with the property manager, whoever else it's going to be, preferably with in-house property management if they're using in-house property management. So that'll help you to understand their company even better. And then you'll be able to get an understanding of how thorough their in-house property management is, which is very valuable. I will say, though, that site visit is just a really critical thing to me, especially the first time. It just tells you a lot about the person, a lot about how they think about the property and the surrounding area, how they analyze it, what they've noticed about it when they've done their due diligence, and how detailed they've been in it. And I'll give you some examples. You may be walking a retail strip center, and I'm sorry I'm using all different assets. I invest across all asset classes. I'm just the ones that are the easier examples are the ones I'm just bringing up to understand. But say you're going down and you're looking at a retail strip center. It's got 10 tenants in it. One person can walk you through each tenant space, show you what it looks like, give you an idea, and then that's the end of it. Another person may actually be walking by the third space and say, oh, by the way, we noticed that there was a crack in the sidewalk right here. We budgeted to fix this. Okay. That is, to me, a reading between the lines. Okay, I'm looking at someone thorough here. That's really good. Like, do I care that they're spending $1,000 to fix the sidewalk? Probably not, right? But do I care that they actually noticed it and are actually detailed enough to even point it out to me? Absolutely. That tells me a lot about the person. There's similar things that you can get from the person on a site visit. For example, at that strip center, the signage is in the wrong place because it's just not really visible because there's a big tree. And when you look at the second entrance, it's being hidden. They may say, look, we're going to reposition it from here and actually walk you over there and say to here for this and this and this reason. Well, that's someone who's been thorough and driven by and really taken a look at every angle, right? You may not get that from someone who isn't as thorough, but you wouldn't have gotten it at all had you not been on site with that person. And now you're starting to actually understand their personality and who you're making a bet on. So those are all really important things, just good examples of why that site visit is really critical if you can do it.
Wow. So sounds like we need to be a good listener, of course, hearing what they're saying or, who this person is walking me around, but also, what questions do we need to know to ask, or maybe some crucial things we need to know to look at or to ask for, different things while we're on site.
I think that that's a good question, but I do think that my approach, similar to what I mentioned in the previous podcast on this topic, is that it's a trust but verify. And so what I mean by that is that I'm not expecting myself to be the expert in analyzing the property that we're walking. I expect the operator to be the expert, though. That's what they're doing, and that's why I want to make a bet on them, because they're an expert in an asset class. And so I like doing a lot of listening, I have to tell you, on those site visits. That's really the main goal of it, is to actually get a sense of how thorough has the person been, what do they think of it, and why are they wanting you to make a bet on it, right? And so from that perspective, you can ask questions if certain things come to mind. And, if they don't, let's say that they don't point out that the signage is in the wrong place, or they don't have an opinion about the sign, you can ask them, have you looked at the signage? What do you think about it? They may say to you, looks fine to me. They may say, they may actually say then, no, we're actually going to move it. Maybe they just forgot to tell you. So certain things that may come to mind to you that you will notice things when you walk a property, even if you're an absolute beginner, because you've walked properties before as a consumer, you lived in apartments, you've noticed things over the years. So you will come up with good questions, and it'll be interesting to see how they're answered. And like I mentioned on the previous podcast, it really sometimes is more important how they answer it as opposed to what they answer. So you kind of get an idea of who you're making the bet on and how thorough they are.
Awesome. Anything else that we need to look for, or maybe even if we get a chance to talk to the property management company or a property manager, somebody like that, anything that you would specifically ask them?
Yeah, I would say that, I would say that whether it's a property manager or the actual syndicator or the operator themselves, I would recommend you get a tour of the surrounding area and ask them for one if they don't. Some of them will actually, in my experience, will actually say, I want to give you a tour of the area, then we're going to look at the property, because they want to show you how thorough they've been in analyzing the surrounding area and why this is such a great property and location. Others will just meet you at the property, but I would specifically ask them in advance to take the time and just say, I want a little time when we're done to tour the area. And that will give you a really good test of how much have they toured the area? Have they just driven from the airport to the property, done their thing and gone away? Or have they spent an hour or two driving the area and noticed certain things? And by the way, when they drove the area, did they even notice anything or not? How detailed are they, right? If they didn't notice much, then you'll know that's the kind of person you're making a bet on. Maybe okay, may not be okay. But if you would be shocked at some of the things, some of the feedback you'll get, the detail and analysis of an area, of other properties, other competitors. Retail is a really easy one to understand, because you can go down a main street and there could be 5 other strip malls within a mile radius, or a mile either way. And then, or maybe even more than that, obviously. And then they're saying to you, well, this property is one of our competitors. We walked in, we have a Safeway at ours. They have a Kroger, but ours is better because this, and this, or theirs is nicer because of this. And we know that, so we know we have to deal with that. Start to get a sense of how detailed have they been looking at the landscape. So that's why that drive by the area, even the property manager should be doing the same thing, because they have to have a sense of the competitors in the area. So that's something I would ask for if it's not actually proactively offered to you.
So how are you personally, or how would you suggest, this investor really prepare themselves for this visit? And like you said, you're not expected to do all the due diligence and to be the expert in the area. However, personally, I'm going to want to know quite a bit about the area before I make the trip, and the expense and the time, to go and drive around and all these things. And it's going to help me to have better questions as well,
Yes.
to ask the operator. So how do you prepare for that, for the on-site visit specifically, or even, meeting the operator ahead, not so much him, but actually going on site and looking at the property and location?
Absolutely. So it will depend on the asset class. And so in some cases, for example, if I'm investing in an infill apartment building in a very dense area, it's not going to help me that much, I think, to go start walking all the blocks surrounding it, apartment. That's a lot to look at. You may spend more time looking at what comps that the operator ran, and then actually focus on those specific buildings, though, and maybe even walk and see virtually where are those buildings, and be ready to ask about, okay, let's go see the comps you ran, why you thought they were comps, and what you think of them, and what research you've done on them. That's one thing that you do to help prepare yourself. On the retail side of things, on strip centers, for example, you're usually dealing with the high traffic kind of a street, and so highly visible street, excuse me. And what I'll start to do is figure out, okay, well, if we had the Safeway here, where are our competitors? I'll start walking down that street, and there's a lot of different properties. Are we at a corner? Do we have 2 or 3 or 1 entrance? Are those entrances easy to access? Are they on the side road? Are they on the main road? And you can start to kind of get an idea, and then you can start to piece together what to expect when you're coming, and start to actually formulate some questions from some of that. So that's another good asset class to look at in advance and walk. That'll actually be very helpful for you to walk the area and see what other tenants there are in the areas and what you're dealing with. With self-storage, for example, you want where you're located specifically because of that drive-by traffic is critical, as I mentioned. So you're going to want to maybe virtually walk things in advance, but then because often those properties could be on a side street, they're not always on the main street, which is fine. You're going to want to get a sense of how much traffic there is. You may look traffic counts in advance, see if the operator looked at the traffic counts. Same thing with retail, traffic counts are really critical. and then start to get a sense of what you're expecting versus what you may see in person, and then compare the traffic counts with the main street, and then, does the other competitor on the main street have a much bigger advantage because of that, et cetera. So it's going to depend on the property. Mobile home parks, for example, totally different, right? I mean, they're going to be probably in a secondary or tertiary location. You're going to want to check the comps, maybe go visit some of the comps in person. And in mobile home parks, driving those properties and driving the actual pavement and seeing what condition the pavement and the parks are in person at those comps is much more important than necessarily than walking into the 5 comp apartment buildings. In the apartment building land, when it's so dense, the rents may be really critical in terms of what the offerings is and the amenities. Whereas in mobile home parks, some of it has to do with the presentation and what condition is the property kept in. So there's different ways to approach kind of getting ready for each one and where you're going to want to attack, but definitely do a lot of research in advance on the area and on the location so you can formulate some of those questions depending on the asset class.
Nice. And you had mentioned, traffic count, and obviously certain asset classes it's much more important. But for most, you may want to know something like that. Where do you find that information?
Well, actually, so I actually asked for that information from the operator because, again, the approach is that they're the expert. If I ask for traffic counts, they don't have them. That's a yellow flag and sometimes a red flag, depending on what stage they're in of due diligence and what type of property it is. And by the way, I'd be less concerned about someone buying a mobile home park in a secondary area not having exact traffic counts than I would be about someone buying a strip center on a main road and understanding the traffic counts, for example, right? So it's not always. And if they don't have them, you can often look at studies that have been done by specific like municipalities and stuff in the past. It's not so straightforward to get, to be honest with you. And some of the sources they come from are more expensive sources you have to pull from. If the operator doesn't have traffic counts and they can't get them from me, that's a huge problem. And if they don't have them to begin with, that could be a huge problem. That alone could make me walk from the certain type of property.
Wow. Great information. I'm glad you mentioned that there too, that it could even make you walk, just not having that one piece of information.
Yeah. If they're buying a self-storage property and they haven't looked at traffic counts, I mean, it's one of the more important things to look at. And so, that one thing alone would make me go on to the next deal.
I know we don't have a whole lot of time, but one other topic we were going to talk about in this, the due diligence for the passive investor, it was just meeting this person and, meeting the operator in person. I know we've talked about it at different times, or whether they're at the, going to this property with us. Hopefully they are, but maybe, we can just take a couple of minutes before we run completely out of time to elaborate on what you're looking for there. Because like we talked about before, they can put on a good show on through emails and on phone calls, things like that. But actually, when you get in person, what are things that stand out to you, about these operators?
Yeah, good question. So it's, I think that the best way to, so there's two things I'm looking for very high level. One is how thorough had they been in analyzing this property and what have they found on it? Okay. And that has a lot to do with listening, like we talked before. So that's very, very important. Number two is their personality what I expected it to be in person compared to maybe a whole bunch of questions I asked through email and maybe a phone call or two, right? So, and by the way, and you can relate to this for sure as a former police officer, am I getting some type of vibe, so to speak, that this is a person I don't want to be dealing with for whatever reason, because that's the gut check, right? And that's why it's so important to meet somebody in person. And so between how thorough are they when they're walking me through this property and how thorough have they been based on the feedback and all the information they're giving to me. And by the way, some of that will actually also come out depending on how experienced they are. If they're really experienced, they're going to know to look for certain things. And if they're not as experienced, they may not know to look at it. And you're going to get a sense of that in person based on how thorough they are. And then who you're making the bet on. We talked about in the last show that's probably more important even than the property itself. In my opinion, the most important thing as a passive investor is who you're making a bet on. That's why I keep going back to reading between the lines, who you're making a bet on. And you're going to get a sense and a gut feel for do I think this person is a good person versus a bad person overall? I mean, just that simple. Am I making a bet on someone who I really want to be driving this bus for us, where I have no control over which direction it's going in? Or am I concerned about how this person's going to drive the bus? And what I would tell anybody is that if you do the gut check after your site visit, adding everything up, and you're not 100% comfortable, then you should just go on to the next deal, because there are other opportunities out there They're going to have similar returns, similar risk profiles. But if you add the additional layer of uncertainty, when in the next deal you didn't have that uncertainty, it just doesn't make sense to go into that. You have a limited amount of capital to invest, and so you've got to make choices that you're 100% comfortable with. So you're going to get some of that by going to that site visit.
Nice. So thank you again so much, Jeremy. Unfortunately, we're out of time, but tell the listeners tell them how you like to give back, and then tell them how they can get in touch with you.
Sure. Yeah. Sorry, it's going to sound repetitive from the last one, but my favorite way to give back, I'm just very lucky because I kind of been living off the cash flow for over a decade, and I've just got a lot of information I've learned over the years through a lot of experience. And so I'm happy to help anyone any way that I can from an investing standpoint, especially people who are new, who have questions. I usually schedule phone calls. I don't charge. Usually it's limited to one call, maybe two, only because of my limited time in the day. But I help many. I don't know how many calls I have in a year, but it's probably hundreds. Where I just don't charge and just try to help people with giving back some of my knowledge and stuff, because I've been really lucky to end up in this position. And then as far as reaching me, please don't hesitate to reach out to me. I'm happy to help you any way that I can. My email is the best way to reach me. It's jroll, JROLL, at Roll Investments, which is ROLL Investments, plural, so with an S.com. So jroll at rollinvestments.com is definitely the best way to reach me.
Thank you for listening to the Real Estate Syndication Show, brought to you by Life Bridge Capital. Life Bridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. Life Bridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.